אהלן יואב,
היי גלעד, צהריים טובים, מה שלומך?
בוקר טוב, אנחנו חזרנו להקליט משני צדדים של האטלנטיק.
איי איי
אני
איי איי איי.
בסדר גמור, איך אתה?
שורדים, הקיץ הגיע, לא משעמם לרגע, במדינה
לגמרי,
הזאת, בחיים בכלל, לא מתלוננים אבל.
לגמרי. טוב חברים, שלום לכם, תודה שאתם מאזינים לנו בכל שעה שאתם נמצאים. אנחנו חוגגים היום פרק 100, פרק 100 מאוד מרגש בשבילנו, חתיכת דרך, אז קודם כל תודה לכם על ההאזנה בכל 100 הפרקים, והצלחנו להביא מישהו שאנחנו חושבים שהוא מאוד חגיגי לכבוד פרק 100, רוברט הגסטרום. למי שלא מכיר, רוברט הגסטרום כתב את הספר דרכו של וורן באפט, אחד הספרים אני חושב הכי טובים על וורן באפט, הוא זכה לשלוש מהדורות, היו לו לדעתי למעלה מ1,200,000 עותקים שנמכרו, הוא היה תקופה ממושכת בראש טבלת רבי המכר של הניו יורק טיימס, יש שלוש הקדמות שכתבו לו, אחד לכל מהדורה, האוורד מרקס כתב הקדמה, פיטר לינץ' כתב הקדמה וביל מילר כתב הקדמה, הגסטרום התחיל את דרכו בעולם ההשקעות אצל ביל מילר. אז קודם כל אנחנו מאוד ממליצים על הספר הזה, גם דיברנו עם הוצאת מטר, הוא תורגם לעברית, יש לכם לינק למטה עם איזשהו קוד קופון עם הנחה. זה ספר שמתמקד בהשקעות של וורן באפט, פחות בבן אדם של וורן באפט, באסטרטגיה שלו, מה הוא עושה, מאוד מקצועי, מאוד מעניין, עם מחקרים, עם נתונים. אני חושב קריאה מומלצת, נכון יואב?
כן, כן, ולא צריך להיות וורן באפט בשביל להבין את הספר הזה, הוא כתוב בצורה מאוד ברורה, פשוטה, אפילו וורן באפט בעצמו אישר לרוברט ואהב את הספר ועשה שימוש בו, הוא אחד מהראשונים אגב, אחד מהספרים הראשונים, תן קרדיט לרוברט שכתב ספר כזה מעמיק על דרכו של וורן, ולא לחינם הוא זכה לכזו פופולריות, ומומלץ בחום לאנשים לקרוא, להאזין, ורוברט בעצמו מנהל השקעות מאוד מוכשר, שלקח כמה מהדברים שהוא למד ומיישם אותם, אז הייתה שיחה מרתקת, זכות גדולה לראיין אדם כזה,
ממש.
ואני חושב
עכשיו, הוא
שפרק...
גם מעיין של ידע, הוא מעיין של ידע, צללנו איתו לסוגיות כמו איך התפתחה שיטת ההשקעות המודרנית הנוכחית, ולמה לא כולם מיישמים את מה שבאפט ומנגר עושים, ואיך באקדמיה התפתחו הרעיונות, ולמה הם קרה, ודרך אגב, הרבה מאוד זה כל מיני עניינים של מקרה, אגו, ופשוט הדרך שבה דברים התפתחו, הוא ממש אנציקלופדיה של ידע, הוא איש מרתק גם כמנהל השקעות, כמו שיואב אמר, הוא ממש מנהל השקעות היום בחסד, עם ביצועים לא רעים בכלל. הפתיע אותנו בכמה דברים שהוא אמר, נכון יואב?
לגמרי, לגמרי. אני מאוד הופתעתי, בטח מההחזקות שלו, אה, מהריכוזיות שבתיק שלו, זה בחשיפה להייטק. ממש מרתק
אני
להאזין
חושב
לפרק הזה.
שההיילייט, סלח לי שאני קוטע אותך, הכי גדול היה, ששאלנו אותו מה וורן באפט היה עושה היום, הוא היה מתחיל, ואני חושב ציפיתי לעשה אותו דבר, נטנץ וכאלה, והוא אמר לא, הוא ילך למניות הגדולות, למאג 7,
נכון,
משהו כזה, שזה מאוד מאוד
הפתיע.
הפתיע, ממש ממש, אבל הכל מנומק, מבוסס, עם המון המון חשיבה, ממש מעיין של ידע,
וקונטרה גדול, לפרק הקודם, שמומלץ גם בחום, של מייקל גרין, שגם זכות ענקית למי שעוד לא שמע את הפרק הזה, מומלץ להשמיע, אנחנו פה נותנים במה, אולי לא לכל אנחנו לא בדמוקרטיה עדיין בפודקאסט הזה, והמדינה שלנו עדיין
לא,
דמוקרטיה, לא
לא, לא
ניכנס
בדיקטטורה, רצית להגיד.
נכון, נכון, אבל סליחה, תודה,
אני,
אבל
אתה יודע, אני לא חושב שהם כל כך שונים, כי זה כמו שבאפט אמר, ש-value and growth are joined together in the hips. אני חושב שכאילו, רוברט לא, הוא לא חושב שיש בועה בשווקים, כן? הוא לא חושב שיש בועה, זה נכון, ובזה הוא מאוד שונה ממייקל גרין, אבל הוא כן מבין שהמצב החוב והדפסת הכסף יוצרים מצב מאוד מאוד קשה, ועוד יותר חושב שצריך עסקים טובים להחזיק. אז אני חושב שיש הרבה קורולציה בין השניים.
בוא נראה, החשש שאני התחברתי מאוד אצל מייקל, זה מה יקרה, הכסף שהפכו את ה-S&P למכשיר השקעה
לכלי ליצירת
שנועד,
פנסיה לאנשים.
בדיוק, שזה יתפוצץ, אין מה לעשות, החברות הגדולות היום בדיוק שיתפתי אותך גם בגרף, אולי נצרף את זה במקורות, שמראה בשנים האחרונות את מגמת העלייה של ה-S&P ביחס לכמה חברות מתוך ה-S&P מגיעות לשיאים חדשים, ורואים שככל שעובר הזמן, פחות ופחות חברות משתתפות בחגיגה. קרי, החברות הגדולות האלה, שהמוכרות לנו הן שעוברות שיאים כל הזמן, וכל השאר נשארות מאחור, ומתישהו כנראה זה ייעצר, ולכן אני קצת חושש, אבל בואו, נחיה
קשה מאוד
ונראה.
לדעת, לפי רוברט
כן,
הגסטרום, הוא אומר שהוא חושב שאמזון יכולה להיות חברה
נכון.
של 8-10 טריליון דולר. הוא דווקא חושב
והרבה-
שהגדולות יהיו יותר
נכון.
גדולות, מאוד מעניין,
ואומרים את זה
הפתיע
גם על
לחלוטין.
NVIDIA, מאוד מעניין.
כן,
כן, שווה
כן, כן,
להאזין.
כן. חברים, אז אתם מוזמנים להאזין לשיחה המרתקת שלנו עם רוברט הגסטרום לחגיגות פרק 100 שלנו. אנחנו נזכיר לכם שזה לא ייעוץ השקעות ולא שיווק השקעות, ויש לנו עניין בדברים שאנחנו מדברים עליהם, וזה רק למטרת העברת ידע, וקחו את זה בפרופורציה, ומי שרוצה לעשות פעולה מוזמן לפנות למטה וליצור קשר. בשמחה נשמח לשבת ולייעץ לכל אחד ברמה האישית שלו, אבל אל תיקחו את הפודקאסט הזה כייעוץ. אנחנו נזכיר לכם להירשם לניוזלטר שלנו, שאחת לחודש אנחנו שולחים את כל מקורות המידע שעניינו אותנו החודש. תעשו לייק, תעשו שייר, תשלחו את זה לחברים, וגם יש לנו נותני חסות בלינקים למטה, גם פספורט קארד, גם אינטראקטיב. יהיה מאוד נחמד אם תצרכו מהם ותעזרו לנו גם לקדם את הפודקאסט הזה ואת הרעיונות החשובים של השקעות ערך בתוך העולם הכאוטי של ההשקעות שיש. אז without further ado, נכון? מיסטר רוברט ג'יי הגסטרום. ביי ביי.
ביי.
Hello, Yoav, and hello, Mr. Robert Hegstrom.
Nice to meet you. Nice to see you guys.
Hello.
Thank you very
Great honor.
much for honoring us for our 100th episode. It is a great honor to have you with us. Me and Yoav are both great fans of your work. For our listeners, we're going to say that Robert, he wrote many books. How many books did you wrote?
Well, I think, 6 principal books, but there have been additions from them. So I think, 6 is fine. Yeah.
But I think the most popular and known is this one, right? The Warren Buffett way.
Yes, that was
this
very
is the
yep.
Hebrew version. I think this is the second edition of the book, and I heard on the audiobook the third edition.
The fourth one already, I think, right?
Yeah,
What?
fourth,
The fourth already. Wow. Now
it came out with the 30th anniversary edition. Was 30 years since I wrote that first edition book.
And just so listeners understand, I think Warren Buffett himself also asked you to use quotes from your book when he read it.
Well, the deal was that when I wrote the book, he had to see each chapter. I wanted to quote from him, right? But his annual reports, as you very well know, are copyrighted. It's the only annual report that I know of in the world where the CEO actually copyrights his material. And so in order to quote from him extensively throughout the book, I needed his permission. And we reached an agreement. He was very, very nice about it, that, I don't know if I can give you copyright permission just yet, but let me see what you're doing. And if I think it's accurate, or, I'm in agreement with what you're doing, then we'll see about the copyright permission. So I had to send him each chapter of the book as I was writing it. And his secretary, Debbie Bazanik, who's still his secretary today, would call me back and say, you're okay, keep going. And by the end of the book, you'll have, as you said, he didn't change a word of the book. And He gave me copyright permission for all of it. So, and it wasn't hard. I didn't second guess him. I just basically told people what he had said. And I organized it in such a way that we divided it between, company tenants, management tenants, financial tenants, and valuation tenants, and then just linked them or aligned them with the great companies that he bought, like Washington Post and Geico and Cap Cities and Coca-Cola, eventually Apple, and on down the road. So, I wasn't inventing anything. I had gone through a mountain load of material to try to tease out what I thought were the commonalities there. So, when we got to the end, he gave us permission, and we were off to the races.
And just to keep you audience know, I think the book is sold more than 1 million copies. I think it was like maybe probably 1.3 by now, or maybe more. And it was a bestseller in the New York Times. And there were prefaces wrote by Peter Lynch, by Bill Miller, by Howard Marks, a lot of great people. And I tell you about myself that I think that this is one of the best books about investing because it talks about the investments of Warren Buffett. You do
Yeah.
talk about Warren the person, but you
Yeah.
focus on the what can we learn as investors from him about how should we manage money. And this is very, very precise and well written. And thank you for it. I think it helped a lot of people and for us
I
too.
have a small confession about your book. When I read it, I think like 15 years ago, when I was just getting into the business, I was making transition from being a lawyer to a money manager. I was taking a trip. I was in Nepal, and your book is so popular that I found like a fake translation. I found a book that they sell in India or Nepal. I don't remember where they sell like these like books for like a dozen for $1, and it's you can see the font is like, oh, you can barely read it. But I picked it up then. I remember precisely on which bus ride I was on when I read your book for the first time, and it had a
Yeah.
really, as Gilad said, had a huge influence on my investment philosophy that I developed over time. So thank you
Yeah.
very much, and it's a great
You
honor
know,
again to have you.
well,
And
listen, we're all the beneficiaries of Warren Buffett and Charlie Munger and other great investors. And you know, I think our task is just to pass it along, which is what you're doing
we're
with your
trying to.
podcast. And you know, we've got a lot of work because people are still struggling. I remember when I wrote the book, all the Berkshirists and the Buffett fans say, "Hey, don't write any more books. Don't say anything. You know, you're giving away all the secrets. You're giving away the good stuff." And I said, well, he's been giving it away since 1965 in his annual reports and all the articles and all the interviews. He's been giving it away for decades before I did. But, you know, to something we'll circle back in our conversation is despite everything that Warren Buffett has achieved, and despite the books that are out there, and there are a lot of great books out there about Warren Buffett, it's still very rare. And the focused business driven investors that Buffett singles out as the way in which to think about investing are a small minority of the overall totality of money management. So, you know, I think it was Charlie Munger that said, you know, it's really quite puzzling how so many eminent places, universities and other places, they think we're really smart and they think we're doing a really good job, but they don't teach anything that we do. So,
So why is that? You know, I want to
well,
start on this one.
yeah,
I think this is when I read your book and I heard you talk, the one thing that was keep echoing in my mind is how come everything is articulated so well
yeah,
by research, by experience. There are so much proof of concept of what is the right
yeah,
thing to do about owning a business, about focused portfolio, about putting emphasis on price, about buy and hold, about not being a trader, all the
yeah,
things that you articulate perfectly in your book.
yeah,
Yet when we go to the academia, and we will go to like, I think 90% of the institutional money managers and all the products that are available for the public, almost, as I said, 90% are not doing what
yeah,
is obviously the right thing to do. How come?
yeah. Well, I think there's two avenues to that. One is, as we were talking offline before we got started recording, is that you know Warren Buffett and Charlie Munger and Lou Simpson at Geico and Bill Ruane at Sequoia Fund. We go through the people, and you know they were all managing money under a value approach that kind of was a low turnover, buy things at a discount to fair value. Don't forecast the market. Don't worry about price volatility. Just kind of buy and hold. You know, good investments. And that worked out for decades, and it did pretty well. That's how Warren was raised, and what he applied in his partnership and at Berkshire. But you know, in the late 73, 74, after the great bear market, there was a kind of a, I don't know, not quite a revolution, but there was a pointed moment where people said, you know, we just blew up the money, we cut the market in half, a lot of people lost their savings. We need to think about a different way in which to manage money. And these, what I call the high priest of modern finance, guys like Harry Markowitz, who would probably be the originator of modern portfolio, Bill Sharp, Eugene Fama, on down the list, you know, had written things in the 1950s about price volatility is bad. If you want to avoid price volatility, you must have a broadly diversified, low covariant portfolio. he never talked about valuation. He never talked about how to think about businesses. He was all about how do you manage prices. And that became what was adopted in the late 70s and early 80s. And so when the new bull market began in 1982, the fall of 1982, when people were scrambling with how should we manage money, these guys raised their hands and said, hey, why don't you give us a try? And this whole concept of broadly diversified, low covariant portfolios, where the objective is to keep stock volatility, variability low, is what took root. And it became the standard approach used by not only brokerage firms, but investment advisory firms and then consultants. And so it was off to the races. And for the last, 40, 50 years, this has been the standard approach. Now, having said that, the standard approach that I just outlined is losing assets. The standard approach that I just outlined has the worst portfolio track record you can ever imagine. If you go back and look at what's called the SPIVA data, this comes from S&P Global, but SPIVA is S&P indexes versus active. Comes out every single year. You can Google it. Just do SPIVA, S-P-I-V-A.
Yeah, we can show it to the viewers why we'll do it.
Scorecard 2024. It's just absolutely amazing, the atrocity that the standard approach performance record has been. It's not just 1 year, it's 1, 3, 5, 7, 10, 15, 20 on down the road, whether you're large cap, small cap, mid cap, value, growth, it doesn't matter, have basically underperformed the market over a period of time that's just, baffles why anybody would embrace this strategy. So, but that's what people sign up for, and that's how money is managed in this country. And then when you say, well, I'm only going to own, 8, 10 stocks, maybe 15 stocks, I'm going to hold them for a long period of time. I don't care about price volatility. I don't care about standard deviation. I just want to, generate good returns over time. People think like you're from Mars. We don't do that this way. We don't manage money this way. And so we're kind of stuck in this kind of tug of war between an approach that's been applied for 40 years that is unsuccessful, doesn't outperform, it's losing assets to index funds, losing assets to hedge funds, now losing money to private equity. But the standard model, which is called modern portfolio theory, has not grown assets in decades because it doesn't work. So it was embraced.
It's basically evaluated to be index investing, no?
Well, that ultimately, because you don't want any returns that are too far afield from the S&P 500, you end up owning too many stocks, too many sectors, so you don't have variance in your returns. And in doing so, you never do outperform the market. That's the problem, right?
So
but then
let's me try to unpack it and make sure I understand it correctly and maybe explain it to our listeners. Basically, what you're saying is that because of downtimes, when there are big crashes in the market that created trauma, so the academia was more focused about how to protect investor from volatility, like strong volatility and big downturns. Said our goal is trying to help you avoid the pain of short-term volatility.
That's
and
it.
Our cure was diversification. We will diversify in order to try to minimize the pain. But eventually, when you take out the pain, so-called, the volatility, the short-term loss, or theoretically lost, you also take out the magic. The one thing.
Alpha,
you take away the alpha, as Yoav said. But I mean, that's basically it. You have two mistresses. It's like, well, one mistress says, I don't want you to have much volatility relative to the market. The other mistress says, well, I don't care about volatility. I just want to beat the market. Well, which one are you going to satisfy? Which one is going to get, the time? So, if you have the mistress and says, okay, we're going to go beat the market, then the other mistress is upset that the variance of returns are too high. And then you say, okay, I'm going to take care of you and say, we're going to keep our returns, variance returns low and not a lot of volatility and standard deviation low. Then the other mistress is upset because you never beat the market. So you can't satisfy both at the same time.
I think that it's like someone trying to avoid crashes in cars. And
Yeah,
so he puts up armor that is so heavy that
yeah,
then the car cannot drive fast
yeah,
because it's too much protected.
yeah.
Now, the most interesting things that I've understood from your book is that, and from what Munger and Buffett told us, and many people show, that volatility is not risk.
No. And it's interesting because if you go back and read Markowitz's paper in 1952 called Portfolio Selection, I think he was like, I don't know, he was 23, 24 years old, never invested in the market, never owned a business, had no clue. He took it upon himself to basically, he was wanting to understand the difference between risk and return. And Graham had for many years, going back to 1934, John Burr Williams had talked about it, had all said that their belief was risk was coincided with the margin of safety. If you bought something for less than what it's worth, you were taking low risk. If you bought something above the margin of safety, what its intrinsic value was, if you bought a price above it, John Burr Williams said this in the preface, you were taking a lot of risk. So their definition of risk was relative to you investing in companies either below or above intrinsic value. That was risk.
What
Markowitz, one
wasn't he the
afternoon,
one? Sorry, wasn't he the one that put 50% of his savings in Berkshire, 50% S&P? Is that
no, that
true?
was Paul. Yeah, that was Paul Samuelson.
Sorry, yeah,
Yeah,
sorry.
no, it's Paul Samuelson did that, and he was a big efficient market hypothesis guy. Yeah, and he did that. He put a lot of money in Berkshire and made a ton of money, and the other half he put in index funds. But as a sidebar, imagine this 22, 23-year-old kid, 24-year-old kid sitting in his dorm room writing his dissertation. He says, "Hey, what if we call risk volatility?" And say, people don't like volatility, and they don't like it when things bounce around. And so we'll say return is expected yield, just like John Burr Williams had said, and but risk is going to be variance of return. Well, nobody, like I said, nobody cared. William Sharp came up with beta in '62. Nobody cared. Nobody did anything. This didn't get any traction whatsoever until after the 73, 74 bear market. And after the 73, 74 bear market, the growth investors weren't going to be the leaders because they blew up the market with the Nifty 50. So they weren't going to be called upon, to resuscitate the market, if you will. The value guys are mostly gone. It's interesting, the 1977 Roger Murray, who took over the value investing program for Ben Graham in 1956 when he retired, took over Ben Graham's seminar class and then took over David Dodd's class in 1961 when Dodd retired. So Roger Murray was the kind of go-to guy. He retired in '77, and the whole value and investing program was gone. There was no Ben Graham class. There was no David Dodd class, nothing. And so it was kind of a vacuum. And a guy named Peter Bernstein, which you may know that name, great guy. He started the Journal of Portfolio Management and wrote some great books. Against the Gods, still one of my most favorite book of all, one of the top 10 books I've ever read. Started the Journal of Portfolio Management, and he started getting a lot of papers from these, PhDs at business schools who were touting, price variance volatility as risk. And they started to build a cult, and people started to, manage money this way. The brokerage firms started risk questionnaires, and all the questionnaires were about how do you feel about volatility? The worse you felt about volatility, the more conservative you were portfolio.
As someone who had the experience of filling up those questionnaires with clients to see them trying to answer those questions, it really is.
Oh, yeah.
I mean, who thought about those questions? Only an academic. I don't know what you want from me. How do I feel if there will be a loss? I don't know how I'm going to feel.
And just think, the other thing that we talked about in the books too is that, you can never actually accurately determine risk tolerance by asking it directly. Because there'll be some days that you'll feel pretty bullish and you've had a good run in the stock market. You'll have a tendency to overestimate your risk tolerance. And then other days, you might have had a bad week, a bad month, a bad quarter, or the market is down or something, and then you underestimate it. So the whole risk tolerance questionnaires are nonsensical. So, but kind of think about it. There were no value guys around. This is before Peter Lynch, before Bill Miller. All these guys. They did get back in the game.
But Buffett and Munger were there. Why
but they weren't. But they weren't focal. If you kind of look at Berkshire Hathaway, they were they were kind of keeping to themselves in Omaha. They were running Berkshire, they were buying Washington Post, they were buying Geico, but they weren't as public a persona as they turned out to be in the late 80s, early 90s.
Until your book came out, you're saying they weren't that famous.
I can remember when the Warren Buffett way came out. It was fall of 94 in the 95 annual meeting. We were at the Holiday Inn Convention Center. There was a couple thousand people. There was no CNBC. There were no reporters. There was no, it was still a very quiet, low key affair.
In the 90s.
It wasn't until, you get into the late 90s and, and stuff like that, that all of a sudden he became rock star. But by then, Modern Portfolio had already had its hooks in the system. It was already, 10 years into it, maybe 20 years into it. And so, the question is, why doesn't it change? Well, just think about all the money management businesses. Think about all the academicians who have PhDs based upon modern portfolio theory. Think about all the money management businesses that have billions of dollars under management based on modern portfolio theory. What do you think they're going to do? Just one day go, oh, all this stuff that, I taught you is a bunch of bunk. And all this stuff that we've been doing to manage your money is a bunch of bunk. We're going to do something differently. They'd lose all their money under management. So none of these people are going to repent. It's because it's in their self-interest to continue to perpetuate the model, no matter how ineffectual the model is. It's just their livelihood. It's in their self-interest to continue to perpetuate even a bad model. And Thomas Kuhn goes through this stuff called Theories of Scientific Revolution. I think it was, I can't remember who it was. It was a philosopher. Charlie used to quote him all the time, and I'm sorry, I'm embarrassed that I've forgotten his name. I'll think of it in a second. But he said, in science, progress occurs one funeral at a time. So the old guard has to die off, right? And then they're replaced by, new disciples, new people, and maybe it takes decades. I know what I do know is this: the standard model, which has been the basis of money management since the early 1980s, is a failed model. It's a failed model because if you look at assets under management, you look at long-only firms, whatever you want to, the amount of money that is moving out of long-only active management into indexing or into alternatives is occurring at such a rate, it can be described as nothing other, explained as nothing other than people are leaving a failed model. Now, that's true. That's what's going on. And other people are picking up the chips on the floor. Private equity says, yeah, we'll give this a shot. Hedge funds say, yeah, we've got a code on how to beat the market in the short run. All these people are coming around saying, yeah, we know how to beat the market. Or in the case of private equity, we can beat the market with no volatility because all our assets are private. But what is not working is the standard model. And as I'm repeating myself, the evidence is the fact of the AUM is in a steady decline, right off a cliff. It's steadily just going down and down and down.
Interesting. So do you think now, if Warren Buffett had to start from scratch, what do you think he would do?
Well, it's interesting because I was having lunch with some money managers yesterday, and they were all talking about the Russell 2000. And so, but Warren and Charlie said, they've said it on several occasions. If we did it, we'd go to the small stuff, right? We'd go to the smaller cap companies with a little bit of, and that's where the inefficiencies are. And theoretically, that's right. What I would push back on is that if you look at the Russell 2000, it's a totally different index today than it was, in the 1980s. If you kind of go back to the 1980s, and this is before, David Swensen at Yale University started the private equity business model back at Yale in the 90s. The Russell 2000 really was the cradle of innovation. If you were a technology company or pharmaceutical, biotech, or whatever the case may be, and you had an interesting idea on how to start a business, you were always launched in the Russell 2000. You got some seed capital, you might have had a little venture capital money, but then they want you to go public as fast as possible because they were running out of money. You needed money to keep the lights on, to pay the electricity, bill, to keep the business running. So you had to turn to public markets for capital raising in order for your business to thrive and succeed. And so there were a lot of really neat companies in the Russell 2000 20, 30, and 40 years ago. Today, if you're an innovative, groundbreaking company in tech or pharmaceutical, whatever the case may be, is the venture capital people have more money than you could. They're like, don't go public. We'll give you all the money that you want. And when you do go public, you'll come out at 10 billion or 20 billion or 30 billion or 40 billion. And we'll get this huge payoff that we had been giving away in the public markets when we did it the other way. And so what happens is the really great companies that you
skip
would
the Russell.
Yeah, but basically they never show up in the Russell 2000 because when they come out day one, they can't be in the Russell 2000. So I don't know, I have to double check my math, but I think, a third of the Russell 2000 now is financial services businesses, small regional banks. So it's not the same index as it used to be. So I'm not so sure. So, long-winded answer, if the Russell 2000 was so undervalued, or the Russell 2000 had so many incredible opportunities for Warren and Charlie to go start all over as money managers, and that's where I would do it. How come private equity hasn't taken a lot of those companies out?
I'm
ahead,
sure you know the work. Sorry, of the work of Dan Rasmussen, who some of your piece on private equity is. He talks about that as well. Anyway, that's his exact thesis, that the small cap value stocks have overperformed because private equity over time would buy them and at cheap multiples, and that's hard to do today.
Yeah, well, so as the question is, they have, private equity is on the equity side, not infrastructure or credit, is long $1 trillion in cash that they haven't even put to work. So if the Russell 2000,
how much?
$1 trillion. Yeah. So if there's so many great opportunities in the Russell 2000, how come they didn't go buy them? Or two, better yet, if you and I, you and I, the three of us owned a company in the Russell 2000 that was trading at prices unbelievably cheap, and we weren't getting recognized by the market for our fair value, why don't we LBO ourselves? We, interest rates are, 3, 4, and 5%, whatever the case may be, well below the cost of capital. We could have borrowed money and taken this thing out ourselves. When's the last time you saw an LBO in the Russell 2000? You don't. So then that begs the question is, and it doesn't beg the question, we must ask the question. People correct me all the time. It's not beg the question, it's ask the question. Ask the question is, well, if all of these things are so cheap, where's the LBO and where's the private equity? And the answer is this: the private equity and the management LBO must not think there's much value here to go after. Okay, so that's pretty prima facie, right? So then the question is, okay, if there's no value there, where has the value been? Where has the most mispricing been? And to the chagrin of the the classic value investors in the old school, it's been in the mega cap tech.
But now, you could go smaller. I just said
mega cap tech, really. I'm surprised.
Look at the returns for the last 5 years. We looked at the EPS growth of the Magnificent Seven. We took out Tesla, put in ASML, and the price return from 2019 through the end of June 2019 through June 2024, 5 years. The price return, right, of the Magnificent Seven that everybody said was in a bubble, the EPS growth rate was the same as the price return. The multiples never changed. So There you are sitting with an idea. These things are growing 20 and 30%. So is their earnings per share? So what was most mispriced in 2019? NVIDIA, Meta, Google, Microsoft, go down the list. And over the next 5 years, their growth rates and earnings per share have smoked the Russell 2000. Smoked pretty much everything else. That's why they were never in a bubble. They were just, very big companies that were part of an AI boom. And, the market moved to that, and they were the players. They were the picks and shovels.
Oh, it's very surprising. Very surprising.
Question is whether they can still keep it up, though.
Well, there's the question, right? So then go back to Buffett. If you ask Warren, and he's said this publicly, where are the mistakes that you have made? What mistakes have you made, Warren Buffett?
Selling too early is where you go.
Oh, no, he said, well, usually we get the cash right. We get, we're usually pretty good about management, not infallible. We make mistakes. He says the mistakes that I've made is one of the tenets are called favorable long-term prospects, which is how long, to your point, Yoav, how long does this last? So, I'm generating 30, 40, 50% return on capital. I've got 30% operating margins. I'm growing at 10 to 15% per year. And when you put that math together, that's a very attractive company. But the question, as Yoav had said, is how long does this last? And so you're trying to figure out the competitive advantage period. To the degree that it lasts a long time, you're going to make a boatload of money. To the degree it only lasts a year or two, then you're going to run into a problem. So, what I think I'm spending most of my time in, is that, so Cliff Asness at AQR says, AI right now can do 80% of the work of my analyst. you can go to an AI and say, give me the 10-year profit margins of Apple, give me the 10-year return on capital of Apple, do a dividend discount model for 5 years, 7 years, 10 years with different. You can give all this stuff to AI and it'll spit back everything that you need within minutes. Okay, so I don't need analysts to do that, right? I got that part figured out. Management's tough, because it's not easily quantifiable. What's the one area that AI can't do right now? Long-term sustainable competitive advantage. If you ask AI, what is the competitive advantage period of Apple or Meta or NVIDIA, it doesn't know. So it can do factoids, it can do math, but to give a judgment call as to all the forces that you need to think about that come together that suggest to you that there is a sustainable competitive advantage period or there's not, is something that we need to be thinking about as long-term investors. And that's what we spend most of our time on.
Very interesting. I want to circle back to a few things that you said, because it's really, really surprising me what you said. First, are you familiar with Christopher Bloomstern work about analyzing the... He's
Semper
also,
Augustus
yeah,
is
Semper
his friend's name.
Augustus. He analyzing, but in general, we would see when we look at the S&P 500, we do see a multiple
Expansion,
raising
yeah.
expansion in the last 5-6 years.
Yep.
So you don't think that the prices are too high at the moment?
Well, there are a couple of things going on there. One is that what people are having a hard time wrapping their hand around are these, trillion-dollar businesses that now are at the top of the list that carry so much weight in the S&P 500. Therefore, they carry higher weight on multiples. They carry higher weight on, a lot of things like that. But it's interesting if you look at the economic return of the, 10 biggest companies, they have economic returns that are mind-blowing. You did the average, profit margins, return on capital, sales growth, go on down the list. It is off the charts what these companies are doing. So when we were growing up, and I got in the business the early 80s, economics was what's called a diminishing returns business. We were a brick and mortar world. And eventually you reach the end point of your map, right? You reach the end point of your market. And every dollar that you put in, subsequently, each incremental dollar that you put in actually would give you a lower return on your investment than had it done previously. So economics is always thought to have been a diminishing returns. Ultimately, we're all going to be dead anyway, right? So, but in network economics, digital businesses, it is what's called increasing returns economics. There was an economist by the name of Brian Arthur, brilliant, and wrote books on complexity economics and increasing returns. And he was at the Santa Fe Institute where Bill Miller and I spent some time. And it became very clear that in the digital world, it's an increasing returns economics, which is the bigger your network gets, the more powerful it gets. The more powerful it gets, the bigger it gets. People want to be a part of the biggest network that has the most eyeballs, the most communications, the biggest opportunity set. So that's why everybody gravitates to Facebook or to Instagram or to YouTube. You can go on and on. So what happens is these things get bigger and bigger and bigger, and the bigger they get, the more attractive they get. And the more attractive they get, the bigger they get. But then the economics, because they're low capital intensive businesses, go through the roof. I mean, NVIDIA, following the Apple playbook, which is outsourcing its manufacturing, is 100% return on capital business. Think about that, right? I've got a business that generates 100% return on capital. Apple's like 125%, right? For every dollar that you get in, you get more than $1 back. I mean, it's mind-blowing, right? And it's also a $1 trillion business. So think about the next 5 to 10 years. Who's going to go up 5 times from here? Who's going to go up 3 times from here?
You
Is it
think
going
that
to be?
the mega caps that are
Oh, sure.
$2-3 trillion can go 5 times?
Absolutely.
Well,
Absolutely. You know,
I saw your equity funds, largest holdings, and I saw that. I was surprised to see they had Nvidia, Amazon, and those guys along with a
well,
few
all
other.
right. So yeah, we've owned NVIDIA's, for 3, 4, 5 years now. We've had Amazon for 9 years. I owned Amazon with Bill when the IP came out. So
Wow.
Oh yeah, we
just think,
didn't say you worked with Bill Miller at the beginning
yeah,
of your career, right?
uh, I worked with Bill for 14 years. He
Oh,
was
It was
director of
probably the
research.
best 14 years for a money manager in
Yeah,
history, right?
unbelievable. Yeah, he's a
and
15-year track.
you said again you've owned. Sorry to cut you off. You've owned Amazon from the IPO. That's
No, no. Well, Bill, I owned it at the IPO, and then Bill shut down Lake Mason, and I came to Stiefel, and I had to rebuy it because we had shut down cap management. Bill still got $9 Amazon on his, in his personal account. But so Amazon's a business where you kind of think about it. It's here $2 trillion business, right?
Mhm.
I think it could be the first $10 trillion business. I mean, think about online. It's the world's largest online retailer. It's the world's largest cloud computing, and it's the world's largest advertising business. Are any of those three things going away in the next 10 years? Is online retailing going to be smaller or bigger? Is cloud computing, even taking out AI, going to be smaller or bigger? Is advertising going to be smaller or bigger? All of those markets are going to be bigger 10 years from now. And Amazon's number one. Why wouldn't Amazon go to 4 trillion to 6 trillion to 8 trillion? There's no reason why it wouldn't. So it's interesting. It's a long-winded answer to say, if I had money today and you gave me $100 million, I don't know if I'd necessarily hang out in the Russell 2000. I mean, what are my
Do
economic
you think
returns
that
there?
Buffett, let's talk about Berkshire. We see Berkshire sitting on a tons of cash. We don't see
Yeah,
them buying any of those businesses, and we see them selling Apple. How do you
yeah.
make of that?
Well, Apple, I think he's right-sizing the position. I mean, it just became way too much. Clearly, though, we're in a lull with Apple. They've got what's called AI fatigue. We're trying to figure out AI and their next handsets, and they've got some competition in the App Store and stuff like that. But it's going to be a fine business. I mean, when you have 25% of the planet Earth owns an iOS system, and the likelihood they're not going to change to Android or to something Chinese, you've got a capture base of a couple of billion users. That's not a bad business to have. Now, he right-sized it because it just became too big in the portfolio and too big as a percent of Berkshire. So, it was clearly a smart idea. The cash level, people have speculated that, Gilad. Some people just think that with this announcement with Greg taking over, that in some ways he's given Greg some canvas. Remember how he talks about, Berkshire is like painting the Sistine Chapel. I have this canvas to
Mhm.
paint. Well, imagine that if you had no cash and every one of Warren's stock picks and businesses and you had no cash, what's your next move? It's like,
Hmm.
what do I do with this, right? But if he gives you some cash and, you've got, 20 billion, 30 billion, 100 billion, 200 billion, whatever the number could be, right? It gives you an opportunity as a CEO for you to start to make your imprint on the business.
Mhm.
And I think that's what Greg will do, both in common stocks and private companies. He's got a lot of money to work with, and that's going to be fun for him. So it's not as off base in my mind as some people make it out to be.
So, some also say, Robert, leads me to another question I had for you, if I may, is the float also, raising in cash also has to do with the insurance liabilities,
Yep.
and he never wants to be in any position where he doesn't have enough cash around. So
Oh
that's
yeah,
also a thing, which is another question I wanted to talk to you about. As we said, why do less people adapt this model for managing money? But also the question that from the beginning, I had a simple question is why do so few insurance companies, and we've talked about a few of them in the podcast that do this, but why do so few have adapted this model of using the float for more equity investments? Why is this so? Even the States, I think you can. They're very Markel. You
yeah,
probably know very well.
yeah,
Very few
yeah.
couples do that.
Well, it depends. Two things happen. One is that it depends upon what type of insurance you're writing. If you're doing automobile and you're breaking things every day, you can't do,
Of
long-term,
course, of course.
common stock investing, although there are common stocks in the Geico portfolio. But two, it's the attitude of the manager that's running the business. If you're looking to have smooth earnings, right, smooth EPS growth, which is what a lot of CEOs attempt to do because the market likes smooth EPS growth. The tendency is you're writing, when policy rates are good, and you're writing when policy rates are bad. And the ending is, you don't know if you've made a bad bet because you didn't get the right price, but you put it in the EPS, and so the earnings per share keep going. But the returns of national indemnity, there's years in which they're killing it. There's years in which they have very little EPS growth to show for it because they're not writing any insurance policies. At State Farm, they write policies. At Progressive, they write policies. So it's the kind of business that you're running. But it's also your attitude about your earnings per share growth rates. There are a lot of managers that want a smooth, upward to the right side trajectory of EPS growth, and to say that yes, this year we had $1 worth of earnings, but next year we're going to have no earnings because I'm not going to pay the prices for insurance policies that are being quoted out there. I'm not going to be in the game, so next year I don't have EPS. There are very few CEOs that play that game, but Warren would. He's just the way he thought about the business.
Interesting.
Very
Yeah.
interesting. So if you think like that, it's very interesting. How do you feel about Bitcoin? I mean, Bill Miller that we mentioned is a great groupie of Bitcoin and some other. Do you see value in it, or it's beyond your circle of competence?
I think once again it depends on where you are. I don't own Bitcoin, and it's obviously a mistake in not owning Bitcoin, but this is kind of how I viewed it. As far as something that's going to replace the dollar, probably not in my lifetime. It's unlikely. But will it be used in transactions in different ways in different parts of the world? And it finally dawned on me when I was giving a talk to a client group that I said that I thought that if Bitcoin would do well, it would likely do very well in emerging markets. Think Argentina, or Colombia or Lebanon and places like that, where you have massive, Turkey, 50% inflation, and
Iran, our popular neighbor these days.
Name it, and it was interesting because we've owned Louis Vuitton forever. It's a little sluggish recently, but it's a great business. We've owned for 10 years, and I remember them saying it's not only Maslow's hierarchy of needs that consumers with discretionary spending like to buy better clothes and garments and handbags and stuff like that as you move up the ladder. I get that, but they also said it's a stored sense of value. A lot of people that leave tough countries and fly to Honolulu open up their bag and they have like 7 Louis Vuitton bags in there and jewelry and other things, and they monetize it. So it's a kind of way in which to get money out of the country. Bitcoin is like that. And I said, if you were in Argentina, if you were in Colombia, if you were in Turkey, and whatever the case may be, and you might think that it would be sensible to have a little Bitcoin that you could get out of the country. You wouldn't even have to go through, you wouldn't have to go through, the line and get yourself checked out during customs. You could move money. And afterwards, a woman came up to me and she says, my family is from Buenos Aires and we've lost 2 fortunes. When the government nationalized the banks, all our money was gone. She goes, you can bet we have Bitcoin. So when I kind of thought about it in that way, I think there are some people that benefit from digital currencies, Bitcoin specifically, because their currency representative is in such shambles, their politics are in such shambles, their rule of law is in such shambles that you just don't put money in the bank anymore. And so Bitcoin becomes an alternative. But as far as here in the United States, I'm not sure how that plays out. The one, you guys can help me. What are these, these stable coins, that Walmart's going to have and Amazon's, everybody's going to have their own stable coin, so, I can produce my own coin at Starbucks and, give you these coins and, you can go around and buy, Starbucks coffee or buy something at Walmart. I mean, it seems to me there's no barriers to entry here. Anybody can start a digital currency. Now, Bitcoin is, I don't know if it's going to be a power law relationship, but Bitcoin is the big daddy, but doesn't seem like, if Trump wants to have a Bitcoin, he can have a Bitcoin, so a currency coin. So what are the barriers to entry here, which bothers me a little bit.
Mm-hmm.
And so there's a lot that I can't wrap my hands around, but there's a lot that makes sense to me. While if I was in Argentina or I was in Turkey Yeah, I would have blockchain and I would probably have Bitcoin. But here in the United States, it's not a high priority item for me.
Robert, getting
Interesting.
back to, you had a question? I
No,
wanted to
please do.
tell.
I'll ask later.
I want to tell Robert about our small study, switching back to stocks, and tell us what you think, or what, how would you and Buffett maybe would think about this. So our thesis was, and this probably, you have this in your portfolio today. What happens to when these great companies, you mentioned Amazon or Apple, so forth, and you said Buffett maybe sold Apple now, not specific valuation, but what happens when these companies become a bit overvalued? Now,
Yeah,
before I answer, I'll just share with you, Gilad and I made a small study about a position that we have, a company you probably know, Texas Pacific Land Trust, and I gave a talk
yeah,
about it. Long
yeah,
story short, we wanted to we checked historically what would have happened, using TPL as example, which was a great company but at a great price. What would have happened to Warren Buffett's publicly traded securities? We used 10 of them, not a scientific study, but we checked over, I think, what period was it again? I think it was over Warren Buffett's holding period. What would have been better for him to hold Coca-Cola and the Walmart and the 10 stocks we used, or hold them and not selling at any price? Or would it have been better for him to use a small, buy them only when they're at a low
To
PE,
sell them when they were too expensive and
expensive,
and buy them again when they become cheap.
exactly,
yeah.
and the results were pretty. Other than for two stocks, it was pretty straightforward that buying and holding, even when they got expensive, was a better strategy. So I ask you, and maybe if you want to say for what you think Buffett 2.0, what would you recommend? What would you do?
Yeah. All right. So let me make sure that I understand you, Yoav. What you're saying is your buy and hold of these 10 stocks actually outperformed trying to buy them when they were cheap and sell them when they were expensive. And
During the time period we checked using Y
yeah,
charts, I hope that our data was, again,
yeah,
not an academic study, but it was
yeah.
interesting to find the results.
Yeah, I'm not surprised. I mean, the timing of, the buying and the selling, even backward looking, it's just very tricky. Warren would say, we got to a point where we had so much money involved, we just couldn't adroitly go around buying and selling and buying and selling, buying and selling
True,
because,
true, yeah.
it just, now you could say if it was a smaller, portfolio, you could have done that. But your point is, if I understand you correctly, which is it's probably not a good strategy to do that at all. And that's one of the reasons why I gravitated to the Buffett stuff. Instinctively, I just don't have good trading. I'm not good at trading. Somewhat instinctively, people talk in an art and a science and art. And I know some traders that they just seem to be wired slightly different, and they seem to have an ability that is kind of interesting, and it has some success tied to it, but it's something that I don't have. So it's kind of nice doing the Buffett stuff that I don't have to forecast markets. I don't have to forecast prices. I don't have to forecast interest rates. I don't have to forecast wars and outcomes of wars. No matter what the landscape is, if someone said, what is the best strategy? I'd say buy a great business. Well, what if we're going into stagflation and, interest rates are going to be this? And if I said, well, what should we do? I said, buy a great business. Well, what if we have a war, and oil prices go to 120? What should I do? Buy a great business. I mean, it never changes, right? None of it says, well, just buy a really crappy business that, it's a commodity business. It's going to work out for a few months, and then you're going to have to sell it and go figure out something else. It doesn't matter what the landscape is. I want to own a company that generates cash, earns above the cost of capital, and sustainably can do that for a long period of time. And if I can get that at a good price, I'm home free. That's all I have to worry about. So
Very
it
good.
is very, very simple. So we may pivot to this, which is, Buffett would always paraphrase Graham, which is investing is harder than it looks, easier than you think.
Hmm.
Okay, the easier than you think part is you don't have to do all these forecasts. I don't have to do all this trading. I don't have to bang back and forth between things and try to figure out interest rates and all this stuff. Harder than it looks part is where we go back to the beginning, which is I own 10 stocks, 15 stocks. I very rarely trade. My frequent, here's, a factoid. I've been at it now 11 years come June 30th in this portfolio. On a month-to-month basis, we underperform 50% of the time.
Mm-hmm.
On a quarterly basis, we outperform only about 65% of the time, which means a third of the time we're underperforming the market on a quarterly basis. And on an annual basis, we're a little bit better, around 70%, I think. It may go to 80%. but we've got a very good, respectable long-term track record. And someone says, well, if you're only beating the market 50 to 60% of the time over the short term, how do you generate above average returns? And the answer is the difference between frequency and magnitude. It's not how many times you beat the market, less how many times you don't. It's how much money you make when you beat the market, less how much money you give back when you don't. And so in value investing, you don't have to be right every month, every quarter. It's when you get paid because you've made a purchase, right? You've made a smart one. When you get paid very well. And then when the market is not shining on your group, or it wants to go buy some other sector, or it's de-risking, or whatever the case may be, is if you've done a value transaction, your downside is usually pretty limited. So for us, when we do what's called upside capture, downside capture, our upside capture is about 118, 119%, which is when markets are improving, we're usually 120% of the market, 118%, which is not, we're growth manager. I'm trying to buy growth stocks that are valuably mispriced. So growth guys are going to win on the way up, right? The problem with growth guys is they give it back wholesale on the way down. But our downside capture and our portfolio is only 105%, which is, we go down just a little bit worse than the market, but not a lot, not like a lot of other growth managers. So as long as my upside capture 118 is better than my downside capture 105, that's my spread. Right? There's the spread. How often it happens is mathematically not a concern. From a client perspective, from an emotional perspective, it's a big concern, because people go, oh, geez, Robert, you're in Louis Vuitton and nobody wants to buy fashion goods businesses. Louis Vuitton has underperformed about 55% of the time since I've owned it. And every time there's a cyclical downturn and nobody wants to buy handbags, I'm told to sell it. And if you understand retail and you understand nobody's going to take out Louis Vuitton, there's not that many players in the space, you just ride through the cycle and you come out on the other side. You don't worry about, I got to sell it and when do I buy it back? We don't play that game. But you just kind of realize that prices move around for a lot of reasons that don't have to do with intrinsic value gap closing, right? Closing the gap. But there are a lot of different people playing different games with different strategies, with different pots of money. And not everybody's playing my game. And so when the market wants to play a different game than I'm playing, I just got to be patient, let it go off onto its, it's doing something differently. As long as my economics are okay, and I understand what I own, I understand what the economics of what I own is. If it wants to go and do, so on February 19th, when, President Trump started talking about, tariffs through, April 2nd, which was Liberation Day, the market went through a massive de-risking. If you look from the election in November up until February 19th, the S&P beat small cap stocks, the S&P growth beat value stocks, tech beat, it was risk on, right? Everybody was risk on. From February 19th through April 9th, which was when Buffett came out and tried to correct the mess that was Liberation Day, consumer staples crushed technology, value crushed technology, growth stocks. The S&P low vol index was the single best performing index. Get this now, the thing with the least amount of volatility had the best performance of all the indexes, because everybody ran to those indices because they wanted low volatility. So they sold growth, high beta tech, and they bought consumer non-durables, defensive stocks, value stocks, low volatility. So at the end, then we did, Michael Mauboussin. Michael's terrific, and he wrote a book with Al Rappaport called Expectations Investing, which Michael Steinhardt used to always say to his analysts, "What do you know that the market doesn't know?" And so an exercise, a Charlie Munger invert, if you will, is just take the price of the stock and do a reverse DCF. And so we discount cash flows at 10%, not modern portfolio theory, equity risk premium nonsense. Just 10% is the cost of capital. We just basically said, with Coca-Cola, and we looked at Procter & Gamble, we looked at Clorox, we looked at Walmart, we looked at Costco. At these current prices, what would that company have to grow at to justify its current price? Coca-Cola had to grow at 19% per year for 10 years. Coca-Cola hasn't grown above 6% for the last 10 years. But because everybody rushed to that side of the market, it was by an expectations calculation, massively overpriced. Walmart had to grow 22, 23% when it just got off a call and told you it's basically a 6% grower. Costco was even worse. Clorox, I think, it had to grow close to 10% and it could only grow at 3%. So you have these huge, and then we went and looked at, Google and Meta and Nvidia and stuff like. Google would have to trade it, grow at 8% for the next 10 years. Okay, you take the over or the under. I think Meta was kind of had to grow at 9 or 10%. Nvidia only had to grow at 15% for the next 10 years. So you take the over, the under. Do you think Coca-Cola is going to grow at 19%? No, I'll take the under. I'm not going to buy it. Do you think that Meta can grow at 8 to 9% and Google at 8 to 9% and maybe Nvidia at 10 to 15? Yeah, I'll take the over. So you can see these things working from a mathematical construct. But from an emotional standpoint, what do you think people were doing from February 19th all the way through the beginning of April? They were selling beta. They were selling tech because they wanted to get out of things that would go down most in price. And where did they put the money? They put the money in value stocks and consumer durables, consumer defensibles, right? That's the safe place to be when the market is de-risking. But now they got a problem. You can see it just in the last few weeks, in the last month. What's outperformed over the last month? What's the best performing sector in the market in the last month? Tech. Number 2 is financials, right? What's the worst performing? Staples. All right. So, the odds are changing all the time. And if, Warren said you walk into the casino, you look at the odds and you decide whether you want to play the game or not.
Mm-hmm.
And if you don't like the odds, you don't play the game. Well, investors just don't think that way. And they just think about price. And, when it's risk on, they want to buy things that are going up. And when it's risk off, they want to sell things that go down the most. And they're not doing value calculations.
You talked in your book a lot about the difference returns and in the size of the numbers of companies in a stock, in a portfolio. That you did an experiment. I think it's only in the last version of the book. Experiment. You took 12,000 stocks to randomly organize them in 3,000 portfolios of 250, 150, 150, and you saw that if I understand correctly, if the portfolio is with the least numbers, like 15. Then like it's 1 to 4 outperform the market, even if you don't choose the companies, you just randomly choose them. So I would like to ask, what do you think for someone managing his own money? What is the number that of companies he should hold to get the best return?
If I was a private investor, and first of all, we own between 20 and 25 stocks, but you have to understand, we got certain fiduciary responsibilities. People have it in their retirement account.
You have regulation, I know. This is why I'm asking someone who wants to manage his own money. No regulation, no clients, only him and God.
Probably own 5 to 10 companies.
5 to 10, that's all.
That's it, yeah. And they would be economically diverse. I wouldn't own all of them in AI, but I might have, 4 or 5 AIs and a couple over here and electrification, energy, and maybe a Louis Vuitton and something. 10 stocks is more than enough for diversification, right? But when you get your monthly statement, 10 stocks bounce around a hell of a lot more than 100 stocks.
You don't open the monthly statement.
Yeah, don't open the statement, right? Buy
10 companies and forget you have it.
But that's really all. That's really all you need as a private investor.
I just had ahead of time, I wanted to ask you about that as well. When you pull back on that, if you take into consideration the study by, I think her name is Henry Bessenbinder from Arizona.
Oh, yeah.
His study, it showed, leaving the fact behind the side that most private investors probably wouldn't have enough knowledge to do that. But his study shows how difficult it is to find stocks that that give returns higher than bonds. So the way I think about it is maybe in a theoretical sense, 10 stocks would be maybe optimal over time, but the chances of you finding, let's say, the next 100 bagger or a 10 bagger even in such a limited list is close to impossible, especially for an amateur and professional investor.
Yeah.
So
you've asked a very interesting question. I guess my first response is that I would invert it and say, if there are only that many companies that can actually add value over time, and that's what's basically his study saying, it's just a fraction of the totality that actually adds value. The rest of them give you a T-bill, rate of return in aggregate. The flip side of that is that's a great argument why you wouldn't want to own a lot of companies because you're probably going to end up with a lot of mediocrity, right?
True.
But your point is, okay, do you have one of the select few, and that's tough, right? That's what we're all trying to do. But I would argue that I don't start at a base rate where it hasn't had a long track record, hasn't had a consistent operating performance. I'm not a venture capital growth investor. I'm more of a better business, better economic return business that's been at it for 10, 15, 20 years or more. And then the question is, they're making money, they're buying back stock, they're reinvesting in the company, they're dominant in their industry, they're top 1, 2, 3, whatever the case may be. Then the monitoring is a little bit easier because you're then just looking at fail rates, right? When are you beginning to lose it? And oftentimes, they don't go from 100 to 0 real quick, but, some trickle down effect, but you can pick that up on economics. So I kind of start with, I've got a really good group of basketball players that know how to shoot threes, and they're really, really good. Now, if their stats start to suffer, we may have to trade them. But I'm not starting with an elementary school kid thinking he's going to be the next Michael Jordan. I've already got a pretty good ball player when I get started with that. The other thing that, that Michael Mauboussin has written about and Hendrick didn't write about, but Buffett talked about is just the natural drawdowns that happen even in the best companies. I mean, Berkshire Hathaway's gone down 50% 4 different times since the 70s. Think about that. I mean, probably the most financially stable business on the planet Earth, right? Run by one of the most incredible managers on the planet Earth. And 4 or 5 different times, the stock went down 50%. Okay, the first thing that tells you is anything can go down 50%. Drawdowns happen all the time, mostly from macroeconomic purposes when everybody pukes them at the same time. But volatility is part of the game. Drawdowns are part of the game. And
it's a feature, it's not a bug.
Yeah. But for us, drawdowns are opportunity. We have made the most money in our portfolio in the year following big drawdowns in market. Unless you think the world is coming to an end, the strategy in drawdowns is push the bet, right? In a drawdown, add beta. On a drawdown, add offense. Whereas most people in drawdowns do what? They sell beta. They sell offense. They buy defense. And so when the market turns, they're totally mispositioned. For us, whether it was right after COVID, whether it was right after 2022, whether it was right after, the de-risking that we went in, we pressed the bets. We add NVIDIA, we add ASML, we added Dell Computer, all through the de-risking process. And so, I was just looking, we were down 50. We were down 15. I'm sorry, we're down 8 to 9% in the first quarter on the de-risking, when the market de-risked. And we significantly underperformed, I think, by 3 percentage points our index. Already in the second quarter, we're up 15% in the quarter, and we're 5 ahead of index. Wow. So, but we didn't go to defense and then come back to offense. We pretty much continued to own what we did, but as the prices of our offense got cheaper, we bought more offense, not defense. And so when this thing turned, and who knows when it's going to turn, right? But when it turns, you're levered to things that are going to go up the most. And that's the way that you have to play this game. But emotionally speaking, guys, and this is the problem, this is the disconnect, why people can't do the Buffett stuff. If you don't understand your business, you don't understand the economics of the business, you don't understand future rates of returns and prices, and you're living with price only data, it's very hard to play this game. It's very hard emotionally for people to take the Warren Buffett way approach. So, I'll give you one last one too, is that when I give a seminars, I say, how many of you here in the group own businesses? Because I tell them, they always say, who's your perfect client? I said, over the years, I have found the most, best client I've ever had were always business owners because we speak the same language.
Mhm.
You have a company. I said, what's most important to you? And they say, we want, I got to have cash. I got bills to pay. I got the mortgage to pay. I want to send my kids to college. If you're a business owner, I want cash, right? And I said, that's funny. That's exactly what I want. And I said, what else do you look at? And he said, well, I look at opportunity costs. I may have a loan at the bank, or, what else could I do with my money? So I want to make sure I get a return on my business that's better than the money market rate or better than the loan that I have against the business, because that's the only way that I can grow well. So I look at returns. And then, I want to keep growing the business. I don't want it to go backwards. And I said, well, that's interesting. You want cash, you want above the cost of capital, and you want sustainable growth. I said, that's exactly what we do. So I walk them through the portfolio. And they go, okay, I get it. And they're great clients. So I go to the seminars and I say, maybe 50, 100 people there. And I say, how many of you have own a business now or have owned a business in the past? And maybe, 10% of the room raises their hands. Like I said, congratulations. You've got the mental construct to be a great Warren Buffett investor. You've got all the training that you need. You don't need me. You don't need modern portfolio theory. You don't need CNBC. Just keep doing whatever you were doing in your business. Do it in the stock market. You'll be fine. And I said, with the rest of you, how many of you own common stocks? All of them raise their hands. And I said, and then I say, well, there's the disconnect, right? You all own common stocks, but you didn't think to yourself that you actually own businesses. And there's the disconnect right there.
Amazing. Robert, I want to ask you one last question before we send you go. And it's that on a different topic, which is a little bit of a blasphemy from the perspective of a value investing, about the macroeconomics. I mean, usually we say, don't look at the macroeconomic in any terms, just buy good business, as you said. But when we look at the debt of the U.S. government and the deficit of the U.S. government and what's going on, I'm a little bit scared. How do you see it? What do you think?
Oh, no. Yeah, I'm with you. I'm scared too. I think what's the old saying? If it can't go on forever, it won't. Well, we're getting into these discussions, and I don't know how the current bill that's going to be coming out in the next week or two is going to, but even adding another $1 to $2 trillion to the deficit in hopes that the trickle down economics of lower tax rates will generate growth that will end up paying for all this is, kind of wishful thinking. We've had trickle down economics since Ronald Reagan in the 1980s, and that hasn't worked. So yeah, this is a big problem. And, Ray Dalio's been writing about it. And there was actually a very interesting study that was done by a guy named, I think it was Adam Ferguson. It was a 19th century, early 19th century Scottish economist that basically looked at all of these countries that had been dominant, but then went on to fail. And the one commonality was at which point the interest expense on their debt surpassed the military expenditures that they spent each year. So
I think we're there, no?
Yeah, well, we are here. Yeah, that's right. And so this is the year that we're going to cover that, in which case, you're spending more of your money paying down your debt than you are putting up your natural defenses, right? And that's the beginning of the end. And so, whether it is that or whether it's, how you think about, Social Security, Medicare, Medicaid, all these other insurance programs and things of that nature, we're at the end of the rope here. And what I do think, though, in a more optimistic scenario, that this does suggest to you that growth will slow, and large economies like the U.S., European, Japan, and all that facing the same demographic relationships. In a slow growth economy, you have to think to yourself, what's the scarce resource? And it's growth, right? Mm-hmm. Right? What is actually going to grow in a slow growth economy? So then you begin to think about, issues of AI, things about electrification, things about transportation, robotics, and things like that. I'm not thinking about, can I sell more Coca-Cola? Can I sell more, Jack Daniels at Brown-Forman? I'm thinking about things that can grow high single digits, low double digits around the world for a long period of time. They will go at a premium. And slow growth economies growth always outperforms value. So another way to look at it, from the peak of an expansion down through the downturn to the bottom, growth has a tendency to outperform value. And then at the bottom of the economic cycle through the next peak, value has a tendency to outperform because value stocks are capital intensive, low margin. They need high turns. They need animal spirits. So you look at value stocks, classic value stocks. Typically, they do well when the economy is expanding. Mm-hmm. Growth stocks typically outperform value, not so much on the upswing, but when things plateau out and start to decline, growth outperforms value because growth can perform despite the macroeconomic landscape that growth is slowing. I agree with you, Gilad. We got a problem with the debt, and that is all going to be summation into slower growth. There's no other way.
And what do you think inflation is going to be in this situation when we have such big debt?
I don't know. It's surprising to me that the 10-year at 4.30 here doesn't seem to be too scared, because that would be the canary in the coal mine, right? Keep an eye on the 10-year. The 10-year seems to be hanging in there very nicely. The last few auctions that we've had, 20-year and 30-year, were actually pretty good. But eventually, these bondholders are going to want to get paid, right? And if interest rates go up, that's bad for the market. So then I'll leave you with this great note, which is from 75 to 82, the biggest sideways market, right? Inflation, double digit, interest rates, double digit. The S&P 500, I think, grew somewhere in the neighborhood of about 8% per year over that 7-year period of time, but 5% was from dividends. The Dow Jones Industrial Average had no price appreciation, all dividends. So the market was basically sideways. You could say, that's interest rates go up, inflation goes up, the economy's in a hard prime, and the market doesn't do anything. It just goes back and forth, back and forth. We looked at the study, and after looking at Buffett's portfolio, there were lots of things that outperformed between 75 and 82. Oil markets, because of the embargoes that were going on in the 70s through the Israeli wars and the Middle East wars when we had oil embargoes. Industrials did okay, but here was the interesting part. Consumer discretionary killed it. Advertising businesses, magazines, television stations, radio stations, low capital intensive, high returns on capital, and they had pricing power. And if you look at what Warren owned, Warren killed it from 75 to 82. He owned affiliate publications, Washington Post, ABC networks, magazines, cap cities, and stuff like that. So no matter what the, Gilad, no matter what the landscape is, good or bad, you got to figure out what's growing.
So I think to conclude our discussion, we basically need to say that just buy a good business and hold it.
And not too many of them.
And not too many of it. A small handful of good businesses and hold it and do nothing more.
Yeah.
Robert, Mr. Hagstrom, thank you very much. It was mind-broadening in many ways.
Thank
you very much for your time. And we'll hope to talk to you again in the future. Thank you very much.
You're very welcome. Thanks for the invitation. Good luck, guys.
Bye-bye. Have a good day.